Tax diversification is one of those main areas that we are working with today. Now, when it comes to taxes, we have taxable accounts like your brokerage accounts. We have tax deferred accounts like your 401ks and retirement accounts, and we have tax free accounts. Now that's what we're going to be talking about today. But first, I want to really dive into some economic news. Let's start with number one, economic and stock market risks. As we move into the springtime, even coming into about the May timeframe, we are actually seeing what we think will be a real acceleration of the US economy. Now, when we say we think, this is going to be a mathematical base here. So what we're taking a look at here is where we were and mathematically where we're going. And that could actually be a very positive signal. Now, what we'll also start to witness, if this is true, will be the breakdown of the US dollar. And right now, everything is what we call correlated. When the US dollar goes down, it's an inverse correlation to stocks, meaning they will start to rise, all else being equal. So when we take a look at that, there could be a very good reason why we start to see a reacceleration of the stock market, but also of inflation. And that's one area that we're starting to really see creep back up. You see, the Federal Reserve now is expected to cut rates in June. And with that in mind, they're really not trying to fight inflation anymore. And when we are going back to their 2% marker, which is what they really wanted to do, they could go from a 3% down to 2%, which is what they wanted, but I don't think that's what they're going to get. So knowing that, they're going to try to navigate this a little bit differently. And with that, I think they're going to allow inflation to start to rise just a little bit. But when we take a look at the global markets and the global economies, we're coming out of this industrial and manufacturing kind of depression and recession that we've been in. So what this means now is that we're going to see a lot of additional drivers for inflation. But we can also see it in places like cryptocurrency. We can see it in places like, well, the CRB index with all the different commodities. You see commodities, and oil is a part of this, are starting to increase back up. And when we take a look at the 19 factors that go into the commodities index, we're starting to see that every single one of them are starting to experience positive trends upward. Now, what this means then is that if we start to see a rise of the commodities, we're going to start to see a rise of inflation coming back. And that may not necessarily be a bad thing though, because when we have growth of our economy, as well as maybe growth of other economies around the world, but also a little inflation, that puts us into what we call a lead to scenario. The Lions Wealth Economic Activity and Development Stage 2. And what this is a growth of your economy as well as a growth of inflation. And that actually can be a very good place for a stock market front to be invested. So yes, there are great things to come, but there's also small companies which have been a terrible place to be invested up until recently. That may change as well. So you've seen inklings of all this really starting to happen. And our clues will be on basically the stocks and the sectors that aren't doing as well right now. And if they continue to not perform, then maybe even a better tale of things to come. So what I mean by this is that let's take a look at, say, utilities. Well, utility companies are great when we are in bad times. Say like a lead 4 structure of our economy where we have a slowing of economic growth and a slowing of inflation. But when we come into a lead 2 where we have economic, really the data picking back up, as well as some inflation, they don't do nearly as well. And so we can actually prove our thesis with the overall sectors. And so take a look at utilities. For one reason, that we could be really coming out of a base for the world's economy, especially on the manufacturing and industrial front. And that could really mean a good summer. Number 2, portfolio changes. There's many things that we've been looking at with respect to the portfolio. Now, we're not making any major changes right now because of the fact we've moved heavily into growth type of investments, but also we're starting to move into, well, Asian countries as well. You see, really we could be seeing a pullback with the stock market any day because of the frothiness that's out there with the US stock market. But there's other markets that are really starting to pick up that are not frothy whatsoever. And so really, we remain optimistic about a lot of this really good growth prospects that these companies have, as well as our economy. Smaller companies, like I said, have been a bad place to be invested, but they may actually be turning the corner as well. And I did mention Asia. Asia is really tied to China. And if China really starts to turn a corner, which is what we are starting to see already, well, then we could be in for a very good emerging market type of environment for us to be invested into as well. So you see, it's not just the US. There are many international type of companies and countries out there that we could potentially be invested in also. So that's how we're starting to structure things a little bit more, broadening the diversification of the portfolio and really taking advantage of what we think will be a great year internationally as well. Number 3, wealth management and advanced planning. I want to focus our time on one element that is often overlooked, and that is diversifying your taxes. You see right now, as we are going through and really coming up on tax season, yes, we actually need to take time and start to realize that there are different ways that we can be storing our wealth for the future. That's what I call the tax diversification. So what this looks like then is that we take into account your taxable accounts, like your brokerage accounts. We take into tax deferred accounts into what we're looking into here. And we take into account your tax-free accounts, like say a Roth IRA or even life insurance. And when we manage this together, this could actually help to maximize your wealth. Now, what I mean by that, when we take a look at the different elements in these different buckets that we're in, what we can start to do is take a look at all of the different ways that we're putting money aside that may be taxable and we didn't want it to be. You see, in a brokerage account that is taxable on a yearly basis, we're paying tax on capital gains, we're paying tax on dividends, and we're paying many different taxes, which actually may not be a bad thing. But then when it comes to looking at, say, your IRA accounts, your tax deferred accounts, like 401ks, retirement accounts, things like that, there may be actually better opportunities to have those capital gains and those dividends invested into those types of accounts. So now we're starting to get into just having the correct assets in the correct accounts. But when we take a look at, say, tax-free accounts, like the Roth IRA or the Roth 401k, or even some life insurances that are out there, well, what we can do then is put money into those accounts that are growing tax-free and may be able to be taken in retirement tax-free as well. And when we look at it that way, when we take a look at where we're at with tax-free money, we look at where we have taxable money that is deferred, but also taxable money that we have on a yearly basis, we can start to cherry pick which ones we want to be taking from in the future. And that actually is going to set us up for a very nice retirement and needs in the future. So how do we do this though? When we take a look at, well, really the accounts that you have, generally speaking, you may have most of your assets in one type of account. So let's say a tax deferred account, like a retirement account. Well, what we can look at then is saying, yes, this may be where we're at today, but let's see if we can actually start navigating this and take a little bit out of this bucket, pay some tax possibly, and put it into a tax-free bucket for the future. If done correctly and done well, we actually can help increase your overall probability of success. And that is what good tax bucket planning can do. So we're not just trying to manage your tax brackets, but we're trying to manage how diversified your taxes are. And that alone could help lower your taxes in the future. Number 4, our second opinion service. We've talked a lot about tax diversification. We've talked a lot about the economy and a lot about what it means to be making sure that your wealth is taken care of today, tomorrow, and in the future. Now, what that looks like then is, well, we're offering you a second opinion. Now, what this would do then is take not only you through this experience, but if you have, say, a co-owner of your business, maybe a colleague, even family members that would like to have a review of their overall wealth plan, this is what it's all about. We took a look at where you're at today. Take a look at where you want to go. And we identify any gaps that may exist in your overall wealth plan. Now, that can be anywhere from the tax diversification all the way to, well, estate planning or even charitable giving. But once we have those identified, you can take those away. You can go back and really work on closing those gaps. And that alone may actually start to help increase your overall probability of success. So what we're offering is a complimentary consultation just for watching today's video. So with that, click the link below. You can sign up for a overall second opinion review, and we'd be happy to go through and lead you on how to close all the gaps that may exist in your wealth plan. So with that, I want to thank you for watching today. Take care, and I'll see you next time.